Hey guys, Corey Young here from Investor Life. And what we do is help investors scale their portfolios without using their own money. Whether you're a newbie, whether you're a seasoned investor, hey, we all need to use other people's money at some point. Today's topic, though, guys, is about the top 3 mistakes when you're analyzing a property. And these things are very, very important to know ahead of time. When you are at the initial stages of analyzing a property, you do not want to make these mistakes. And we have helped hundreds of different investors all across Canada when they are at the stages of analyzing their property. And these are the most common things that we see. So that's what we're talking about today in our video. So mistake number 1, guys, and that is underestimating your expenses and underestimating your total purchase costs. For example, when you're analyzing a property, one of the things that you want to do is make sure that you're using legitimate numbers. If we are throwing in today's investment climate 3%, 4%, even 5% for our mortgage interest rate, we might be underestimating what our actual expenses might be once we own that property. In particular, if we're going to be renting it out long term and our costs are significantly higher month over month, every single mortgage payment we make, that's going to make a big difference on whether or not that property is successful. But not only our monthly expenses might we underestimate, also our total purchase costs. And this is an important one because here we go. Let's say we're going to buy a $500,000 property. A lot of people think, well, we need 20% down as investors. That's $100,000 down. So I need $100,000 to buy that property. But there's a lot of other expenses that are included in that we have to take into account. So one of the main ones is, of course, we need to pay a lawyer, legal costs. That could be anywhere from $1,000, $2,000 or higher. What other closing costs might we have? Give you an example. Sometimes you buy a property and the homeowner may have already paid the taxes for that year. You need to reimburse them for that amount. The taxes could be $5,000, $6,000, $7,000. And if you're buying it near the beginning of the year, you have to reimburse them for that amount. So that's another cost that would come off of what you would normally pay monthly, but it is an initial cost that is part of your purchase costs. Okay, so things like that pop up in the closing process. You might have land transfer tax to pay. You might have some repairs and renovations that you have to account for. You might have an appraisal. If you're getting a mortgage, you're going to likely have to pay for an appraisal or get an inspection done. All of these types of costs could easily add up to 15, 20% of what you were counting on. So if you were counting on $100,000, it might be 115 or 120 that you're actually spending to buy that property initially. Mistake number 2 that we're going to talk about, and again, this seems very, very obvious, but it would be overestimating our income or overestimating our rents, or maybe we're planning to do a flip, overestimating what we will actually be able to sell it for in the end, not maybe accounting for some of our expenses that we're going to have when we do go to sell that property. So these are, again, some of the things that we need to account for up front when we are making our initial analysis. Let's say we're planning on buying, holding for a long period of time, a property, and we're going to rent it out. What are our rents going to be? How can we verify what type of rents or the amount of rent we're going to be able to collect on that particular property? Well, initially, and we're going to get into this in another video in more depth, but what we suggest is doing your research, pretending that you're a tenant looking for a property like that. Put it in Google, search it up, see what sites come up, search those sites and figure out, okay, I'm looking for a 3-bedroom house in this particular neighborhood, in this particular city, in this particular province. What are they renting for? Pretend you are that tenant looking for the property. That will help you determine what types of rents are being charged in a particular market at that time. Another good way to do would be talking to your property manager, talking to your investment focused realtor, asking what their opinion on what that property would rent for, using the resources in your team around you. That's how you're going to get a more accurate number because we don't want to overestimate these things. Mistake number 3 is also very important for us to talk about, and that is not planning an exit strategy up front. Okay, so a lot of times when we're buying a property, we might think, well, I'm going to buy this because it's a great deal. But what is your exit strategy? Do you plan to hold that for 5, 10, 15, 25 years? Or do you plan at some point to be taking advantage of the appreciation in the market and maybe looking to refinance it? Or are you planning to take advantage of the appreciation of maybe a renovation you're going to do and you're planning to sell it? What is your exit strategy out of that property? How long do you plan to hold it? Because a lot of times what we see a mistake that is made is somebody buys a property thinking, I'm going to hold that for a year, 2 years. This market is going up in value. I'm going to rent it out in the meantime. I might do a little renovation and I'm going to sell it in a couple of years. I'll give you an example. One client of ours that we helped coach through the process initially planned to buy a property and convert it to a student rental. It was right close to a university. Well, that's all fine. And they did increase their monthly income, but they didn't think about their exit strategy. Now, when they went to go sell that property, it was more difficult to sell as a student rental. They're not selling to the entire market of homeowners out there anymore because it had been converted to a different type of property. So now their niche of who they're selling to was significantly smaller. They're looking for just an investor to buy that property. So that's just an example of when you sometimes change the use of a property, you got to take into account what your exit strategy is going to be. And if you're planning to keep that one forever, then hey, that might be a great strategy. If you're planning to sell it relatively soon, it may not be. And so these are the things that you need to consider ahead of time. How long you're keeping the property, and who is the market that you're going to be selling it to. And of course, you want that market to be as large as possible because the more buyers you have, the better chance you have of selling it. So that's our top 3 mistakes that we see, guys. We don't want you to be making those mistakes. And just so that you're aware, a little tool that we have that will help you to analyze properties. We have a fillable PDF property analyzer. The link is in the description. If you want to download that, it's absolutely free. And it asks you all the important questions that you need to know when it comes to analyzing a property. Do not skip a beat when using this property analyzer because every single question on there is there for a reason. And another video, we're going to go over in depth really the importance of using an analyzer like this when you go to initially analyze a property. So that's it for today, guys. Thanks for joining us for our video, and we will see you soon in our next video. Take care.